For the next hour, you'll be leaving the show me state and entering the show me the money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you deserve and need to help you with your wealth management and your retirement planning. And my name is Jeff Shade. And as always, I'm just here to ask the questions, but the words of wisdom and solid advice that come from Randy Floyd and Jake Floyd of Floyd Financial Group. Randy off this week. Jake, did you notice how I changed up the intro there a little bit? Did I throw you?
A little bit, Jeff. But I know you like to keep it interesting, so I'll just roll with it.
Yeah, well, I feel that people listen to the radio program, they're reciting the intro along with me. It's part of a mantra that they have every Saturday for the radio program. But anyway, how are you doing this Saturday morning?
Jeff, I'm doing great. Thanks for asking.
I am glad to hear that, Jake. Good for you. Fall is upon us here. I know you like the colder weather, and we're going to get it here now. Here in Springfield, we haven't had the colder weather. I've got a home in Tennessee. We've seen 40 degrees overnight.
Wow. Yeah, that's definitely cooler than it's been here. We had 3 weeks ago, we had a couple of cool mornings, but for the most part, it's been north of 60 here, and in some cases even still more like 70. So I am looking forward to some colder times. I do think a lot of the farmers around and people that have land would also like a little rain. So I'll keep my fingers crossed for some rain. I know my creek is dry right now, and I would like to have some more water there.
Yeah, well, there's a problem when the creek runs dry, as they used to say. Anyway, September upon us here. Temperatures are beginning to drop along with the leaves a little bit, too. And, of course, Halloween stuff's been in the store for a while. Jake, I went to the hardware store over the weekend, and do you know that they had Christmas stuff out already? It's September, and we got Christmas stuff coming up here.
It's the same at my hardware store, yep.
It's just too much. Let's not rant and rave like old people do here, Jake. Let's talk about some important stuff. I'm a little older than you, so you're too young to rant and rave just yet. But nevertheless, we're so happy to be with all the fine people here at Springfield, Missouri, the last bastion of sanity. Let's talk a little bit about current events. I understand that some political people are accepting donations in cryptocurrency.
Yeah, so there was a report that came out that cryptocurrency donations for political campaigns has hit about $190 million, which in the grand scheme of things is not a humongous number, but it is certainly a lot larger than it has been in the past. The majority of those dollars are going to Donald Trump's campaign and other conservative campaigns that are deregulation of crypto friendly. One of the big thorns in the side of the crypto industry is Gary Gensler, who's the head of the SEC, who seems to believe that there's nothing on earth that is not within his purview, whether it be crypto or all the different types of assets that he's been trying to pull in over the years. And so I think that Trump, along with J.D. Vance and others, have pretty well vowed to put a stop to that, and I think that's why a lot of these dollars are flowing toward them. So I think it's likely we're going to see crypto continue to be a major factor. Again, there's no necessarily rhyme or reason for the valuation on crypto, so I do like to stress that cryptocurrency involves a certain degree of gambling where you're not investing really because there's nothing underlying there's nothing being produced. That doesn't mean you can't make money. A lot of people have made a lot of money, but you do have to understand that, it's not a safe, retiree-friendly asset class at this point.
Well, because political candidates such as Trump are accepting cryptocurrency for donations, do you think that that's going to make crypto more acceptable to a broader audience?
I don't know. I think a lot of the people that like crypto at this point or have accepted crypto, you have probably as many people that are going to accept it as you will for a while. Crypto's not new anymore. I remember back in 2017 when Bitcoin made its first run, I had a Christmas party and everybody and their brother was asking me whether or not we were going to buy crypto in their portfolio and Bitcoin specifically. And I was like, please, please, please don't buy it here. Because it was at like 19,000 a coin. Mm-hmm. 6 months later, it was about 3,000 a coin. So it went way back down. And then since then, obviously it's come back, but it's so volatile that, if you are going to buy some, it's okay to buy a little bit maybe, but just realize that there's nothing underlying that. There's no business that's making money. There's no product underlying. And so that makes it a little bit riskier because it's pure speculation that drives the price.
Well, I'm waiting for the day when I roll through McDonald's and in addition to them asking, are you going to be using the mobile app today? They're going to ask, are you paying with crypto? I wonder if crypto is going to be accepted at fast food restaurants at any point in the future.
I think the turning point for the acceptance of crypto will be when, kind of like if you go to a foreign country and you run your Visa card, right?
Yeah.
All that's done behind the scenes where you're paying with euros or pounds or whatever, but you're running your credit card and you're seeing dollars being deducted, or added to your statement. I think eventually we'll see that be done integrally.
Yeah.
Is that the right word?
We're going to make it the right word for our purposes right now, Jake.
So it will be integrated into
sure.
the payment software, which is honestly a huge concern for a lot of Americans, especially conservative Americans, because once they can do that, that's kind of the building blocks and the framework necessary for crypto-based digital currencies where, the government has control over those currencies and that kind of thing. You can't have that happen like Glenn Beck's been saying is going to happen tomorrow for the last 3 or 4 years. Mm-hmm. You can't have that happen until credit card companies and things have really integrated that into their system. So that's why I'm fairly confident that's not going to happen real soon. I do think it will happen at some point, but until we see the Visa and MasterCard and payment companies really embrace that and make it to where it's seamless for you to pay and buy and change for crypto, I think it's going to be hard for it to have staying power.
That's going to be interesting if you have a crypto card. I mean, right now I've got a debit card that is connected to my bank account, but can you imagine a crypto card where you can pay with cryptocurrency? I think that's on the horizon. I'm going to make that prediction right now, so write that down. Talking to Jake Floyd at Floyd Financial Group, and if you're just joining us, this is Show Me the Money for a Saturday morning, and we're talking about cryptocurrency donations to political campaigns. Let's switch to big company Apple and their AirPods. I understand now that their AirPods can be used as hearing aids. What do you know about that?
Yeah, so Apple, as usual in September, had their product launch for all this year's new products, and it was largely uneventful as it has been for the last 6 or 7 years, except some people will find it interesting that their AirPods will now be able to be used as hearing aids. So the technology for that in noise canceling and then the ability to hear people through the AirPods has been there since the beginning, but they have now developed it to where it can be used as an actual hearing aid. So that'll be a much cheaper alternative. If you've bought hearing aids recently, you'll know that hearing aids are worth more than their weight in gold.
Oh, yeah.
If you can buy something for $250, it's somewhere in that ballpark. That's way, 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 way cheaper than the average hearing aid solution, which can range anywhere from $500 to $5,000 without any trouble, depending on what you're looking for. And it's Bluetooth enabled, which is what a lot of hearing aid people are looking for. So, I think that could be a little bit of a game changer where they're going to access a group of people that traditionally don't buy a lot of their ancillary products.
Yeah, my brother-in-law has hearing aids, and it's amazing what they can do. Apparently, they sync to the TV so he can hear the TV set. But as you said, they're quite expensive. On the open market, it's not hard to spend $3,000 for a hearing aid. A lot of people can't afford that. But I think if you're a veteran, as he is, he's able to get them at either no cost or a great big reduction. Yeah. And hearing aids, that's something that's not covered by Medicare at all, even a portion of it, Jake. Is that right?
Yeah, there can be a pretty big gap there for some people. I would say, though, that, for $3,000 or $5,000, I think it ought to be able to sync to your car and start it for you. It ought to be able to sync to your coffee maker and, get you a drink out of the fridge. I think we'll see, humanoid robots that cost less than that in the near future. So I think they better get with the program.
Well, a lot of people going without because of the cost of hearing aids, but the AirPods are not going to be as invisible as hearing aids. And, these hearing aids are so you can't even tell somebody's got them in there. So,
oh, yeah. They'll just mistake you for being hip now, because you'll have like half the people in New York walking around with one AirPod in, listening to music or talking on the phone or whatever. They'll just think that you're a very with it 75, 80-year-old person.
Distracted walking, that's a big problem in New York. It really is a problem. People are so concentrated on what they're hearing in their ear pods, or they're looking at their phones, they're bumping into people, they're getting hit by cars. cabs or whatever. Anyway, a lot to talk about on today's show, Jake, and we're going to get to it in just a moment, but I did not want this segment to go by with some rather big news. It's been going on all this week. Wendy's is selling junior bacon cheeseburgers for 1 cent. And they started it to honor National Cheeseburger Day on September the 18th. 1 cent for a junior bacon cheeseburger. Boy, that ought to bring some more people into the fast food restaurants.
Yeah, I think what's maybe the most fascinating part about this, you have to buy something else in order to qualify for that and everything.
Right.
But Nelson Peltz, who's a very famous activist investor, has had a stake in Wendy's. He's owned about 10% of the company for quite a while, and he's had 3 board seats that recently got lost, and he's exiting his position. This was announced 2 weeks after that. So I assume it's probably because they've been wanting to do this, but Nelson wouldn't allow them because he's all about that profit, and so he doesn't want to let one dime go to waste. I do think that in an era where everything is so expensive, I think this could turn out to be a good loss leader for them and really drive some business. We'll have to see what happens.
National Cheeseburger Day was September the 18th, which was last Wednesday. I forgot to celebrate. But anyway, this deal goes through September 22nd, so that is through today, and I think maybe tomorrow. So 1 cent for a junior bacon cheeseburger. That is less than it cost in, I don't think that it's ever been 1 cent at Wendy's, but nevertheless, I'm going to crew. Yeah. I normally don't go to Wendy's, but I'm going to go through just to get it. I have nothing against them, but I'm going to go through just to say I could get a cheeseburger for 1 cent.
And it's fresh, never frozen at Wendy's.
Yeah.
That's what they say.
That's Dave Thomas from back in my part of the country, Columbus, Ohio. In our next segment, I do want to talk about ETFs, so we're going to get ready for that. We got a lot to talk about on today's show, Jake. We'll also be talking about unrealized capital gains, people who want a 12% return on their investment, whether or not that is doable or feasible. Again, if you're intrigued by what we have talked about today, you want some help with your retirement planning, we invite you to give us a call. Our telephone number, 417-889-7233. That is the number for you to call this weekend to get in and sit down with us here at Floyd Financial Group, talk about your individual journey towards retirement. Now, it's just a casual conversation. There is no judgment whatsoever. It's a chance for you to ask your individual questions to get the answers that you need to put yourself on a path towards a confident retirement. There are no questions that are off limits. And as always, there is no cost, no obligation. And as we said, there is no judgment. We will meet you where you are. So take advantage of the opportunity this weekend. 417-889-7233. It'll take you about a minute to make that call. Leave your name, telephone number. Ashley will call you back during the week and set up that appointment for you. Once again, 417-889-7233. You can also find out more about our firm online at floydfinancialgroup.com. Jake, time for a break. When we come back, we'll talk about those exchange-traded funds and more when Show Me the Money continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about ETFs. They're hot right now, but are they the right investment for you?
That's right, Jake. That is a question that I have had many people ask me, and unfortunately, I do not have the definitive answer about ETFs. So, hey, let's find out from you, Jake. What is that? I understand it stands for Exchange Traded Fund, but what exactly is it? How does it work?
Yeah, and so to make a blanket statement like they're good or bad is to kind of miss the point. Let's talk about what an ETF actually is. Like a mutual fund, which have been around for a very long time, ETFs came about more recently. I think the first ETF, SPY, was offered originally in 1993, and then it took till 2000 and a little bit after for them to start catching on and really became mainstream over the last 10 to 15 years. Mutual funds are a collection of stocks and or bonds. But in the beginning, and really even still today, a lot of them are actively managed, meaning they have a team of managers or a manager who makes the decisions within a framework that's pre-developed for this mutual fund. So let's say, it's an index fund to the S&P 500, meaning it's supposed to track the S&P 500. So anything that changes in the S&P 500, they try to mimic that change, and then minus their expense load, they want to try to mirror the S&P 500. Or let's say that it's a small cap mutual fund, right? If it's a small cap mutual fund, then They're trying to mimic the performance of a small cap fund. So those are index funds. Some mutual funds are just celebrity type investment advisors that just literally pick stocks and buy them inside the mutual fund. And there's even some hedge funds that are traded as mutual funds out there. Some of you may remember all the buzz around the Magellan Fund back in the 80s and 90s and all the money that was made. And so as we're thinking about ETFs, it's very similar to a mutual fund as far as it's a collection of stocks and or bonds. But in the beginning, ETFs were largely passive, meaning there's no active manager. We simply buy the S&P 500 if that's the one we're talking about, and we just buy it and hold it. There's nobody trying to make a lot of decisions and things around it. Or maybe we want to buy just the tech sector, so we can buy a tech sector ETF. And so because there's not a lot of active movement inside there and a lot of thought being put in, a lot of research, the cost of the ETF is significantly lower on average than the average mutual fund. ETFs are not necessarily good or bad inherently. They are just a slightly different animal. One of the main differences between ETFs and mutual funds is a mutual fund calculates its price every night after the market closes. So let's say you have an S&P 500 mutual fund and it's noon on that day and the market is down 2%. You're not going to see that reflected in the price of your mutual fund until after the market closes. And so you'll see that price the next day for the previous day. Versus with an ETF, it trades live on the exchange like a stock. And so if the market's down 2% and you're in an S&P 500 ETF, you're likely going to be down about 2%, and it's going to trade live. So you can get in and out of it during the day, not just at the end of the day. So that's one of the main differences. And you may think, hey, that doesn't really sound like it matters that much. And in the grand scheme of things, it doesn't. But there are days where it does. And that's one of the main fundamental differences between the two.
Okay, so I get the concept of an exchange-traded fund, much like a mutual fund. So what are some of the reasons that someone would or would not want to take advantage of the opportunity to own an ETF?
Yeah, so think about ETFs largely, most of them. There are some actively traded ones, so I'm not going to say, blanket statement here, but for the most part, where the most dollars are allocated and what most people own, think of an ETF like departments in a grocery store, right? So maybe I want to own all the small cap stocks. I can put all those in an ETF. Maybe I want to own all the growth large cap stocks like Google and Apple and Amazon and that kind of thing. I can put all those inside an ETF. And as you're building a portfolio with asset allocation, you say, hey, I want 5% of my portfolio in the growth ETF. I want 10% in the small cap ETF. I want 40% in the S&P. And you can build a portfolio that way at relatively low cost. Most of those ETFs are also kind of self-policing, because if you're buying something like the S&P 500 and its goal is to manage to the S&P 500, any companies that leave the S&P 500 will also leave your ETF. Any companies that get added will also be added to your ETF. And so it kind of manages itself. And so if you're looking for a really low-cost, low-maintenance solution, ETFs, especially index ETFs, can make a lot of sense. It depends on how much of an investment expert you want to be, but certainly as you're beginning your accumulation, meaning if you're 30 and you're wanting to invest some money, this can be a good way to go about it because you're diversified. You can put a very small amount of money to work. You don't need $100,000 or even $10,000 to get started. You can have very small amounts of money and have relatively good success. Where it starts to become an issue is when you have major transitions in your life. Maybe you change careers, maybe you're getting ready to retire, and that's where a financial advisor will earn more of that money in a situation where you have lots of major decisions to make, understanding tax ramifications and things like that. But certainly early on, owning like an index ETF at 0.03% cost can be very attractive.
Jake, let's say that something comes along and I need money. How liquid are exchange-traded funds?
Yep, so you can sell those things live on the market as long as the market's open. And if you need money out, if you're dealing with a major brokerage firm, you can usually have that money over the next few days.
So depending upon the underlying investments, though, can these be difficult to trade, or can you always find a buyer for an ETF?
So I hesitate to say always. There are some of these ETFs that are very small in size. That's something you should always pay attention to when you're looking at a mutual fund or an ETF is how many dollars are allocated to these shares. So like the S&P 500 ETF is a very, very large ETF, hundreds of billions of dollars. There's some of these that people launch and they've only got $10 million in them, which sounds like a lot of money. But if you have, let's say, $10,000 in it and you need to get your money out, if everybody's selling at the same time, you can run into liquidity problems. So as long as you stick to bigger ETFs, so I would say certainly ETFs that have $1 billion or more in them, you're going to have very little liquidity troubles. And I would say just the vast majority of ETFs you're fine in, but there are some exceptions to that people should be careful of.
Okay, so I understand the concept of an exchange-traded fund, but also it sounds a lot like a mutual fund. What would be the advantage of doing an ETF over a mutual fund?
Yeah, so the two main differences, kind of like I was talking about a minute ago, I think your two main differences is the ETF is traded live on the market. The mutual fund is assessed its value at the end of the day. And again, it depends on your style. That may not matter at all for you if you're just going to buy it and hold it. The cost on most mutual funds that are index funds and ETFs are fairly close, so there's not a huge cost difference. Usually you have a little bit easier time auto reinvesting into mutual funds and things like that. There's several reasons for either. It's not that one's just necessarily better than the other. You also may not be able to get certain strategies in a mutual fund that you can get into an ETF or vice versa. They may just simply not be available. But there are still vastly more mutual funds out there than there are ETFs. I think the last count, there's like 60 or 70,000 different mutual funds out there. So you can get more specific in a mutual fund than you can an ETF. But it really just depends on how complicated or how simple you want to keep things. Cost, again, is a very big key to that. On average, ETFs are less money simply because they're simpler strategies and we don't have to pay a bunch of Wall Street executives to run it.
Let's talk about safety a little bit. Are mutual funds more secure than ETFs? I mean, what are the other big advantages of a mutual fund over an ETF?
I don't think there's really any difference in the nature of the setup, whether one's more secure than the other. I do think that, mutual funds have just been around longer. Also, most of your retirement plans and employer plans are made up with mutual funds, so people have a little bit higher confidence level in those. There's not really an inherent difference there, although I think people perceive it to be. People are used to seeing mutual funds in all their retirement plans from the 70s and 80s and so on, and so they have a little bit higher comfort level. ETFs are a little bit newer, but there's no real main difference between those two things that would give me pause.
Are there a lot of exchange-traded funds to choose from, Jake, and how do you vet these depending upon what I'm looking for in my investment portfolio?
So, Jeff, I think that if people are listening to this show and they're trying to figure out how to do things themselves, and some of these questions that you're asking are confusing to them, they may want to seek a financial advisor for advice. ETFs are relatively simple instruments by and large. They're prepackaged stocks and or bonds, depending on the strategy. I want to make sure that people listening to this show are not going to sit here and go, "Hey, Jake said ETFs are the thing to do." So I want to make sure that people listening here are not thinking this is blanket advice to them.
No.
But by and large, ETFs are cheaper, and cheaper in the long run for the client is better. Meaning, if you pay 1% less in fees, let's say over the next 30 years, and you do the compounding depending on how the returns come, you could have literally double the amount of money 30 years from now that you have today simply by paying 1% less in fees and having those compound returns bigger and bigger. So there's huge return differences if we can keep costs low. I think that's the biggest reason why ETFs were introduced in the beginning. And probably the biggest reason that they're still around is the average cost of a mutual fund is somewhere around 0.7%. And I would say if we did a weighted average of how many dollars are in each ETF and then how much the fees are on each ETF, again, I don't have this number here in front of me, but I would guess it's probably closer to 20 basis points or 0.2%. So it's significantly cheaper. And you can also kind of get all the flavors that you want easily. So sector ETFs were kind of all the rage back in the 2000s, where we say, hey, I want just the tech sector, or I want just the utilities sector, or I want just the consumer staples sector, or the financial sector. And so it was a way to kind of play on things that you think are happening. So like, for example, if we end up with Donald Trump as president, he will likely drill for oil. If we drill for oil, and we drill a lot for oil, we're going to have more oil in this country. If we have more oil, then the price of oil will go down, right? Supply and demand. And so we might not want to purchase, if that was our thesis, we may not want to purchase oil stocks and things like that. And so we can buy other sectors that are not the oil sector and leave the oil sector out. And that would be a way to kind of tailor a portfolio into a certain strategy. Again, I think the average listener here has no intention of wanting to devise their own strategy.
No.
Some of the people listening here, or clients of mine, you do own a few ETFs inside what our model is. Now, I want to own as many individual stocks as I can in the models that I build because, there's no fees less than zero, right? If I own stocks and hold them, there's no ongoing fees for that. And it also allows me to be very specific. However, if you're kind of just getting started or you want a more broad and diverse strategy, owning index ETFs could be a good thing for you.
Well, Jake, I'm sure that based on a conversation today that our listeners may have some questions for you or Randy about exchange-traded funds. If that is you, I would encourage you to give us a call here at Floyd Financial Group at 417-889-7233 this weekend and request your no-cost, no-obligation Floyd Financial Group retirement analysis. Again, it's not going to cost you a dime. There is no obligation, certainly no judgment. We'll talk about exchange-traded funds, mutual funds. We'll talk about taxes, Social Security. So once again, take advantage of the opportunity right now while it exists, and it's going to exist for a little while, but nevertheless, why not do it today? 417-889-7233 is our telephone number. No cost, no obligation. Make that call. Phone lines are open right now. Leave your name and telephone number. Ashley will give you a call back during the week and set up that appointment for you. Again, 417-889-7233. You can also find out more about our firm online at floydfinancialgroup.com. It's time for a break, Jake. When we come back here on Show Me the Money, we'll be talking about unrealized tax gains and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shade.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about unrealized capital gains tax. What does that mean, and how likely is it that we end up with something like that?
Unrealized gains have been a hot topic recently. It's particularly true given the upcoming presidential election because there are some different opinions on that. So let's talk about unrealized gains. First of all, what are unrealized gains?
Yeah, so let's talk about gains in general. So if you have money that is not in a retirement plan, meaning after-tax money, and you invest, let's say, $100 in a stock, and it becomes $200, that $100 difference is called an unrealized gain if you haven't sold it. Mm-hmm. Once you sell it, it becomes a realized gain, and then it depends on whether or not it's long-term or short-term to determine exactly how much in taxes you might owe. What has been proposed recently by the Democratic Party is taxing unrealized gains, meaning if I have that $100 I put in and it's worth $200 today, Kamala said probably a month ago now, she said, hey, we're going to do a 25% unrealized capital gains tax. What that would mean is you have a $100 gain in that scenario, and she's going to tax you $25 whether you sell it or not.
Wow.
That has a very unique capital destruction implication that almost no other tax policy has. So what you would have is you'd be assessed a tax on something you haven't realized, meaning you don't actually have the money to pay it. So you'd have to come up with that tax money from somewhere else. Or you would have to then, after being assessed that tax, sell your position and then pay more taxes on it because you sold it and now you have a capital gain. And so you have this very dangerous downward spiral when it comes to taxing unrealized gains that I think, frankly, a lot of the people in Congress don't understand. Otherwise, they wouldn't be talking about it.
Yeah, now what happens, obviously, if you have an unrealized gain, you say that Kamala Harris wants to tax that, but what if it goes the other way? What if I got stock that I bought for $100 and now it's worth $80? Am I going to get money back under her plan, or how does it work?
Yeah, I'm sure they're not going to give you a 20% unrealized capital gains credit. I can promise you that's a one-way street in any legislation that they would look at. Although that would be fair, right? If they did that, that would only be fair. a lot of people are thinking about how this relates to them personally, right? This would apply to the stock market, but this would also apply to land prices, assuming that they don't exclude that, which there was no talk of that. So let's say that you have a farm that you paid $100 an acre for 50 years ago, and it's now worth $5,000 an acre. So you put, let's say, $10,000 in before, and it's now worth $5 million, depending on how long ago you bought it, where you bought it, and all that kind of thing. That would mean that you would have to pay not only your property tax, but you would have to pay an unrealized capital gains tax each year on your land gains. And so when we're thinking about that, I mean, you're talking about something that's totally not feasible, would result in the destruction of the entire economic system in about 2 or 3 months. I mean, it would be absolutely catastrophic. Now, because of that, I don't think it's likely that we're going to have a 25% unrealized capital gains tax. The question is, would they do a 1% or a 2% or a 3% unrealized capital gains tax? And I think that could be likely that they may try to push for something like that if we end up with a Kamala Harris presidency.
Well, you were talking about the price of land going up. I was thinking about home prices. Let's say that your home price increases as well, too. In addition to property tax, am I going to have to pay an unrealized gains tax every year because my house went up $20,000? I mean, it doesn't seem like that there's an end to this. What if I've got, collectibles, I've got coins, I've got artwork, I've got anything that increases in value? Are they saying that I'm going to be liable for unrealized gains on that? And the other thing is, what if there's a dispute as to how much it's gone up? I mean, for every thing that you sell, there's got to be a buyer for it. So I would imagine there's going to be disputes as to the value of something. I don't see this really coming to any good end.
Well, and are you going to do an appraisal every year on your property to find out how much it's worth and how much you owe? I mean, is the government going to pay for that appraisal?
Yeah.
There's a million problems with this, right? And I think what will likely happen is it'll be limited to equity and stock type investments, even if they try to push for this, and it'll be 1% to 3%. Even at 3%, though, you're talking about a significant destruction of wealth. Guys like Elon Musk, right, who probably has less than $100 million in the bank, but he's worth $150 billion, right? He would owe even 3% on his overall portfolio. He'd have to sell $5 or $6 billion a year worth of his stock, forced selling, and then simply give it straight to the government, which is destruction of wealth in the stock market overall. I think companies where they have CEOs that have large shareholder CEOs, NVIDIA, Tesla, frankly, most of the top 10 or 15 stocks have this problem where they'd have tons of forced selling every year just to pay the tax bill. Again, it's hard to put emphasis on how bad that would be. It would be very, very bad, which is one of the reasons why it hasn't been talked about before, is it's very destructive to wealth in general. Even some of the other ideas that we're going to talk about here, also like getting rid of the long-term capital gains tax rate or doubling the tax rate of long-term capital gains. Right. Those have major implications of liquidity of markets. So meaning if you've tried to go find a house to buy right now, you've probably noticed there's no houses out there, right? That's a liquidity problem, meaning there's not enough buyers and sellers in the market to provide liquidity. I think that would raise that by a factor of 4 or 5 probably if we had a situation where everybody would want to exit all at the same time if they thought that 2 years from now they were going to have to pay a higher capital gains tax, or heaven forbid they were going to get rid of the step up in basis. Literally everybody with a gain is going to try to come out over the next few days and try to sell, and you only have so many buyers. So again, that would be significant wealth destruction. The one thing I would say that makes me sleep pretty well at night on this issue is Congress is not going to hurt themselves. We can count on Congress to be self-interested and greedy, and they're not going to pass legislation that is going to take money out of their pockets, which this definitely would in almost every case. Nancy Pelosi, likes to buy calls on companies she's planning to force feed money to, not buy investments that she knows she's going to gut with her new tax plans. And so I think we can all take a little bit of solace in the fact that Congress is not going to hurt themselves. While there may be some negative tax policy coming, I don't think it's going to be super radical, but that remains to be seen.
Well, as you said, I mean, any kind of change like this would have to go through Congress, and that would not be possibly an easy task. I was thinking about businesses. Let's say that some guy opens up a donut shop here in Springfield. I mean, when he opens it up, it's not worth anything, but he owns it for 5 years or 10 years. He builds it up through a lot of hard work and sweat equity. He doesn't take a salary, and now it's worth 2x. He's got to pay, X as far as taxes go. I would think that that would be a detriment to people opening up businesses because they're afraid their business is going to be worth something. It's going to be an unrealized gain, and it's going to put them out of business. So I don't see that this is ever going to fly. And I guess the question that I have for you, Jake, is there any end to, the government looking for ways to tax us even more?
Well, when our country was founded, taxation was theft. It was illegal, and so we had to pass an amendment to allow taxation in this country. Well, I don't mind paying taxes for things that, we're going to use. I don't mind having the roads rebuilt and things like that. I think a lot of the bigger issue is what they're spending it on. I think a lot of people listening to this show would be more okay with paying more tax if they were not just blowing it on stupid things. I think that the spending, and not necessarily the total spending, although that's a problem too, but more specifically, what money is being spent on needs to be heavily re-examined. I think there's a lot of foregone conclusion spending of hundreds and hundreds of billions of dollars every year that nobody's even looking at. They're just like, well, that's how much we spend on that. Mm-hmm. And I think that we have a massive spending problem in this country. And even if we're not going to reduce spending, because reducing spending would hurt the economy and other things, so I don't think, even if that's the right thing to do, would be to rein in the spending. I don't think we're going to see any president do that, in my opinion. But if we can make sure that that money is going to causes that actually benefit people instead of useless research projects or some other things I can't even talk about on the radio that they're spending this money on, I think people would feel better about the situation and wouldn't be so tax averse.
So, Jake, isn't there an accountability department or office? Isn't there anybody overlooking this sort of thing in the government to say, hey, maybe we better not spend, $100,000 on leaf blowers blowing, lizards off trees in Florida to see how they hold on? I mean, isn't there somebody who says, no, we can't do that?
There is supposed to be. However, lobbying and too many people with too close a relationships are, it's really more about who you know. Be like, hey, can I get some of that federal money to do whatever project it is I'm looking for? And it really is a game of who you know. And if you know the right people, those people that are making the decision on those committees, you can get some pretty crazy things to get federal money for. I mean, some of this federal money is going to research projects in Vietnam and other places. It's just, It's totally crazy what's going on with the spending. And trying to find new and more creative ways to tax the American, I don't think a lot of Congress has a basic knowledge of economics. The more you tax, the worse it gets. You have less to use to generate taxes the next time, right? And so I think being careful about how we're spending the money is how we will fix the problem, not simply endlessly taxing Americans more and more and more and more.
Well, I think this conversation points to the fact that tax minimization and saving on taxes wherever you can is so important in a retirement plan, and that's why we have Rod Link on our team here at Floyd Financial Group, because Rod's an expert not only in the reporting part of it as a CPA, but also you, along with Rod, do some forward-looking tax planning to make sure that we're not paying any more in taxes than we have to. And really, when you look at what they're spending this money on, I'm telling you, this really can get your blood pressure rising. We're talking about taxation, and we're talking about unrealized gains with Jake Floyd here of Floyd Financial Group. Again, you've got questions, we've got answers. 417-889-7233 is our telephone number. Give it a call this weekend to request your no cost, no obligation. Sit down with Randy and Jake there at Floyd Financial Group to talk about your individual situation. And of course, there is no judgment. We'll meet you where you are. 417-889-7233 is our telephone number. You can also find out more about us online at floydfinancialgroup.com. It's floydfinancialgroup.com. Time for a break, Jake. When we come back, we'll be talking about 12% returns. Is it possible? All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpa, Jake Floyd.
Welcome back to Show Me the Money. I'm Jake Floyd. In this last segment, we're going to be talking about expecting too much out of your portfolio in retirement. Are you looking for a 12 or 15% return? That can be dangerous.
I'm looking for that, Jake, but I don't expect it. There's a difference between looking for it, wanting it, and actually expecting it. So I want to explore that a little bit. Do you have clients who come in and say, Jake, here I am. I want a 12% return on my investments? What I mean by that is, do you have to maybe reel people in every once in a while, bring them back to reality?
More than every once in a while. We have this discussion a fair amount. I would say it is possible to make 10% or even maybe 12% over the long haul. You just have to be ready for the volatility that comes with that. If we look at like large cap growth stocks, they've averaged in excess of that for the last 20 years. But the problem is you have companies like NVIDIA or Amazon, right? In 2022, NVIDIA was down 78%. Now it's up 1,200% since. And so it has made good gains. But are you really ready to watch your retirement portfolio go down 50%, 60%, 70%? If you have $1 million saved for retirement, you're planning to draw $4,000 or $5,000 a month off of it. Are you ready to watch it hit $500,000 or $400,000 trying to swing for the fences on these big returns? And so I think swinging for the fences is okay, especially when you're younger, when you have time to make it up, and a certain amount of risk tolerance helps you build your portfolio over time. But once you get in that retirement red zone, that last 5 years or so before retirement and then into retirement, discretion can be the better part of valor. And it's less about making a huge return than it is about trying to not make big mistakes that we can't recover from.
And Jake, I was wondering where we got this 12%. I did a little research on this. There's something called the Stocks, Bonds, Bills, and Inflation Series, and that data spans 98 calendar years from 1926 to 2023. And if we take the simple average of the historical returns over that period, you'd get 12.2%. That's where the 12% everyone's talking about comes from. The problem is that even if you invested in that exact same stock market index over that period, you'd have actually earned 10.3%, not 12.2%, due to the effects of volatility, as you said. So if we're throwing 12% out the door over a long period of time, Jake, what is a more realistic expectation?
So that really is going to depend on who your advisor is, or if you have one, whether you're a saver or an investor, what your risk tolerance looks like. I will tell you, I don't want to get into specific, rates of return here, just because there's so many varying ideas of what a portfolio should look like. But what I would say is we can make more than 3 or 4% over the long haul. We don't need to make 12% for you to have success in retirement. The biggest thing we need to do is not experience a 2008 scenario where you're missing 55% of your portfolio. That's really the things, because once you start drawing money out of your retirement portfolio, it totally changes the game. Whereas before, when you're 25, you can just wait for it to come back. And honestly, even when the market is down, that just means every dollar you fund is now funding more shares of whatever it is that you're buying. And when it comes back, you'll just be better off. In fact, prior to retirement, you really don't want the market to be up. You want it to stay low for as long as possible as you're funding your retirement, because you're going to buy more and more shares, and then you want it to be up right as you're retiring. Especially if you're under the age of 45 or so listening to this, don't be concerned about the noise in the market. Keep funding, make sure you understand your risk tolerance to make sure you're not jumping out when you should be jumping in, and vice versa. But otherwise, just keep funding that thing. Now, when you're getting closer to retirement, that's a different story, and you need to have a good hard look at how much you have saved versus how much you need to withdraw off your money, and what kind of returns you can expect will be dictated by those things.
And you talked about losing over 50% of your retirement funds, back in like 2007, 2008 because of the housing crisis. I was looking at some stats here. And the dot-com crash of 2000, the market was down 49%. Housing crisis, 2007, it was down 56%. 2020, COVID-19 pandemic, it was down 34%. So volatility, that is something to consider. but also inflation as well, too. That can really throw a monkey wrench into your returns, can it, or can it not?
Yeah, and so inflation, generally is looked at as a bad thing. I will say that inflation generally comes with inflation of asset prices, right? While a lot of people are complaining about the fact that everything costs more, and it does for sure, and I can understand and sympathize with that. If you had money invested over the last 4 years, your investments are also worth a whole lot more. Your house is worth a whole lot more. Your land is worth a ton more, right? And when we're thinking about this 12%, this arbitrary number, whatever it is, even in retirement, you're going to have years where you hit those numbers if you're invested well. It's not that you're never going to make 12%. It's that to average 12%, even when the market's down, it requires so much risk taking that it's, in my opinion, generally not appropriate for retirees to be taking that much risk.
But Jake, let's say that someone comes in and they're insisting, I need 12%, the 6 or 7% just isn't going to do, Jake. I want to swing for the fences. Do you educate and inform people that, hey, there's a lot of risk involved with that? You could lose a great deal of money. Are there people who just want to go ahead with that? And as a fiduciary, would you even swing that hard to try to get people 12%?
So by and large, if somebody just came in and said, hey, I want to make 12% every year, I would probably honestly kind of show them the door. Generally, people that have like some arbitrary number like that in their mind, that means that they're not paying attention to the bigger picture. Because if you're trying to make 12% every year, you're oblivious to where we are in the cycle. You're oblivious to a lot of other things that are going to contribute to an overall average return. Like I can show you I have lots of different things I can show you that have a 12% average return if they started investing in 2009, right? Because my starting point was so low. The market's up 800%. It's very easy to come up with that, right? Versus if I have somebody that started at the top in 1999, their return doesn't look nearly so good because there's more time and less return. So your starting point is a huge part of that. And even just 6 months can make a huge difference in your overall returns over the next 20 or 25 years. And so generally speaking, if I have somebody that comes in and says, hey, I'm not interested really in a plan, I just want to make a huge amount of money, those type of people are also the same kind of people that tend to go running for the hills whenever things are going against them. They say they have a big risk tolerance, but generally speaking, they don't. And so in my experience, it's usually not a good fit for my style of money management and my type of planning. And so I generally do not bring on people that are looking to hit home runs.
And Jake, again, I want to point out to our listeners, I want you to hear this, that we cannot guarantee any particular rate of return. We just can't guarantee it. We will do the best that we can with the knowledge that we have, with the experience that we have to get you a good rate of return, but we cannot guarantee anything. We did a segment last week on how long $250,000 would last you in retirement. Would you say that $250,000, someone comes in, if we achieve a 3, 4, 5% return on our investment, that it's possible to get through retirement without too much pain, or do we need more than that?
I like to aim a little bit higher than that. It really depends on the person, though, and depends on what their needs are and what they want to have happen with their money. And I know I say that about everything, but it really is central to how we build a plan. Again, we're not looking for 12, but I am looking to make a good return. I want to make sure that you have the best retirement possible if you come in here to see me. As far as coming in with $250,000, whether or not that's feasible is totally dependent on your spending habits and your Social Security and other pension income and things like that. So I can't say certainly over the radio whether $250 is the right number or not. For some people, it's more than enough. I have people that have $1 million+ and they're not spending anything off of it. I mean, they're just growing it. It just really depends on how much you're needing to spend, what your commitments are. We work the plan in, including the expected rate of return, is determined largely by how much risk you are comfortable with, but also, do you really need to take the risk to achieve your goals? If you don't, then maybe we take a lot less risk for a little bit less return, knowing that really maximizes our chances of you being where you want to be. Some people, even if statistically they're in great shape from a risk tolerance standpoint and a return standpoint, some people just don't like the idea that their money is in the market fluctuating. They just don't want any risk. And there are things we can do there too. Generally speaking, I think a blend of strategies is a better approach, but I do have people that are just like, you know what? I don't want any of my money in the market, period. I don't want to ever lose a dime of my money. And, we have solutions for that as well. So I think what we try to focus on more than the actual rate of return, while I have people that have earned well in excess of what we're talking about, even on the high end of this over a period of time, I have people that have way higher average returns than 12%, depending on the starting point and that kind of thing. I do think that's an unrealistic number to shoot for. And what we really want to focus on is the plan that gets you to where you want to go, not just some arbitrary return number that may or may not fit your goals.
And again, I think that's the most important thing that you said right there. In order to meet your goals is that you got to have a plan. That is the number one thing that you need in retirement. And again, I'll point out that we can't guarantee anything, but no matter how much money that you have, if you come in and see us, I think that does increase your chances of making a good return on your money to get the advice that you need. So how do you get that? You call 417-889-7233. Why don't you go ahead and give us a call this weekend. Leave your name, telephone number. Ashley will call you back during the week and set up that appointment for you. We'd love to talk to you about what your hopes, your dreams are, and what your expectations are, because we're here to help you get to retirement and keep you retired. So again, it's not going to cost you anything, certainly no obligation whatsoever, and no judgment to get that help that you need. 417-889-7233 is our telephone number. You can also find out more about us online at FloydFinancialGroup.com. Jake, it's been a real pleasure talking to you here. I want everybody to have a great fall weekend. For Jake Floyd, I'm Jeff Shade. Have a blessed weekend. We'll talk to you again next week with another edition of Show Me the Money right here on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and are not intended as investment advice for any individual or entity. All information contained herein believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning offered through Floyd Financial Group, LLC, an investment advisor registered in the state of Missouri.